Elikhulu is a great project for us. It was delivered on time, on budget, actually a bit of ahead of schedule. It's currently producing at circa 65 to 70,000 ounces per annum. It was a big project. It was about $130 million project. It's incredible that we built the whole plant in 12 months. And the really special thing with Elikhulu is that we actually turning old rehabilitation liabilities in the form of old tailings retreatment facilities or old tailings dumps. We're actually retreating these dumps. We are redepositing the dumps on a lined facility, which is sort of in line with modern standards, so i.e. cleaning up the environment. And we're producing gold safely, and we're producing gold at an incredibly low all-in sustaining cost. So at this point, Elikhulu, from an all-in sustaining cost perspective, runs well below $650 per ounce.
Right, very, very attractive, very attractive. And so that's, sorry, remind me, so that's going to run for how long?
The life of Elikhulu at this point is in the order of 12 years.
Right, okay.
So again, it's quite a long life asset.
It's quite a long life asset, but at the same time, I notice you're putting a lot of effort, time and money into. You've got some construction projects, feasibility studies which have been completed, being optimized. You've got some pre-feas activity. You've got some exploration going on. So you're not standing still, because you can sort of see that these projects will be depleted at some point. And if you are to continue to grow this company, you've got to develop it. So do you want to get into some of the initiatives that you're working on at the moment?
Sure. Look, I mean, it's key in gold mining. Any sort of mining that you continue to reinvest in your assets, you find new ore bodies to mine. And I think as an industry, we haven't done sufficient exploration. Everybody's talking about the sort of production cliff that is looming. And certainly, I mean, it's clear that in recent years, people haven't been spending capital on finding new ore bodies and developing new ore bodies. So as a group, we're in a fortunate position where we have more than 30 million ounces in resource. Now, some 10 years ago, that used to count for something. The markets, rightly at the moment, put no value on gold in the ground. Okay, so I mean, clearly we have to bring this gold to account. We have to deliver gold and profits, and ultimately also again dividends. So from a project perspective, I'm quite happy that sort of we're meeting guidance for this financial year, which ends at the end of June. So our guidance was 170,000 ounces. For the next financial year, we're actually bringing one of these projects to account. So that is mining the 8 shaft pillar at Evander. So it's an underground project, but because it's very, very close to the shaft, the costs would be certainly manageable. So we've guided that we should be producing at an all-in sustaining cost of $900. Right. And for the next financial year, it should give us another 20,000 ounces of production, so 15 to 20,000 ounces of production. So that already takes us for the FY20 financial year to production of 185,000 ounces, which is a significant increase. And then we have additional projects at Evander that we're working on, the most prominent being Egoli, which is an underground project, but again, quite close to the shaft and close to infrastructure.
Okay, so so they are coming into production. So when did you say?
Well, the first project, which, as I've said, for the initial period, the first year, should contribute 15,000 ounces or even more, 15 to 20,000 ounces. That project is actually coming in production as we speak. So we're in the process of doing the development. The first gold will be in our plant in August. And that's why we are able to increase our guidance for FY20, which our financial year ends June 2020, for the next financial year. That project will already be contributing and be positive from a cash flow perspective and a profit perspective.
Okay, you're getting up to 185,000. Working your way towards 200,000. You're a meaningful producer by anyone's standard. Obviously, you're trying to drive the cost down, the operating cost down, and improve margins all the time. But I'm looking at this. This is a very localized, diverse project. You talk about having diverse risk, but it's still very concentrated. It's kind of like the equivalent of infill, isn't it?
Again, there's risk in mining. So the first and the most important risk to us is safety to our people, and I'm very happy and proud to say that that we one of the safest producers in South Africa. It also doesn't hurt that we get half of our gold from surface tailings, which inherently is just less risky. But if you talk about concentration risk, if you look at our business, we actually have a number of different projects or operations. So if we talk about Evander, we have Elikhulu, which is the tailings plant. We have this new pillar project, the 8-shaft pillar. So those are two very distinct and different projects. At Barberton, we have the tailings plant we call the BTRP that gives us 20,000 ounces. And even the underground operations come from 3 different shafts. So, yes, I mean, we might be concentrated to some extent, but there's an awful many parts that actually make up the sum of our production.
No, I get that. And it's just I want to understand. I think everyone else wants to understand. So what's the thinking? What's the strategy? What's the goals here? Because it's like you're sweating the assets that you have to create, lots of small, incremental, but valuable contribution to the overall production. But is that what you're happy continuing to do, because you think that is a model which is going to work for you, because you're going to be able to drive the costs down? Or do you feel that there should be are you keeping your eye open to other M&A activity, whether it be in South Africa or elsewhere in Africa, presumably, to diversify the country risk, for instance?
Sure, it's a very valid question. So our shareholders, certainly most of the South African shareholders, are, let's call it them, risk averse.
Yeah.
And we're in a fortunate position as a group where we don't have to go and buy anything else or develop anything else. If we quite simply run our assets properly over the next years, we should see significant value unlock, because we're producing at, as I've said, at this point, well below the gold price, which means we're clearly making quite a lot of money. We're de-gearing the balance sheet quite quickly. And so all the debt we have on the balance sheet really was incurred to construct the Elikhulu tailings plant. That is, as I said, $130 million. So if we only run our current assets properly like we've been doing, you should see quite a significant value unlock, purely because of sort of profits generated, de-gearing, and that translating into shareholder value over the next couple of years.
But do you think it will? Do you think it will? Because cash sitting on the balance sheet, I've seen companies with 400 million on the balance sheet, and their market cap's 500 million, and it's ridiculous. Yeah. So, do you have confidence in the market that is the case? If you start, you've de-geared the balance sheet, as you say, you paid down debt, and you're producing cash, reasonable margin, and you'll drive that even more, hopefully. But is that going to be enough for shareholders to actually see a bump in the price?
Well, look, I mean, as a management team, unfortunately, we can't directly impact the share price. We sort of look at the share price, but we take a view to say, let's do what we can do operationally, financially, socially, everything else, to make sure our business is robust and sustainable. And the share price over time will take care of itself. So, in terms of shareholder value, what does it mean? As I've said, we need to demonstrate we run our assets, that translates into profits, that hopefully will translate into dividends again in the next couple of years. We've been in the past, we've been one of the leading dividend yielding gold stocks in the world, and a number of our investors want to see us go back to dividends. So that's key for us. And then hopefully the price takes care of itself.